Imagine waking up to a world where $41 trillion, nearly twice the size of the U.S. economy, has vanished from global markets in a single night. This isn't a Hollywood blockbuster. It's a chilling warning from Bank of America that's rattling Wall Street to its core. Foreign investors are pulling back, U.S. debt is spiraling, and the dollar's dominance is crumbling as nations race to ditch it. From pension funds to grocery budgets, this financial firestorm could hit every corner of your life. We're diving into the forces behind this $41 trillion threat, why it's closer than you think, and how it could reshape the global economy forever. Bank of America's latest report has set off alarms, warning that $41 trillion in global wealth is at risk of evaporating due to a perfect storm of economic and geopolitical pressures. The U.S., long seen as the bedrock of global finance, is losing its grip. With federal debt soaring past $35 trillion, exceeding the nation's annual GDP, investors are questioning the safety of U.S. assets. For decades, the dollar and treasury bonds were the world's safe havens, but skyrocketing debt, high interest rates, and global instability are shaking that trust. Foreign investors, from China to Saudi Arabia, are shifting capital to emerging markets, gold, and alternative assets, signaling a seismic change in global investment flows. If this trend accelerates, a rapid sell-off in U.S. bonds, stocks, or the dollar could trigger a chain reaction, hammering markets, pensions, and banks worldwide. The U.S. debt crisis is at the heart of this vulnerability. The government's $35 trillion debt pile is growing faster than the economy, and the Federal Reserve's high interest rates, aimed at curbing inflation, are driving up borrowing costs. Servicing this debt now consumes over $1 trillion annually, crowding out other spending. If major bondholders like China, which holds $800 billion in U.S. treasuries, or Japan, with $1.1 trillion, start dumping their holdings, bond prices could collapse, pushing yields higher. This would spike borrowing costs for mortgages, car loans, and businesses, hitting Main Street hard. A 1% rise in Treasury yields could add $200 billion to the government's annual interest bill, further straining the budget. The ripple effects would be brutal. Higher mortgage rates, pricier car loans, and tighter business credit, squeezing families already battling inflation. De-dollarization is pouring fuel on the fire. BRICS nations, China, Russia, India, Brazil, and now Saudi Arabia, are increasingly trading in local currencies or China's digital yuan, bypassing the dollar. In 2024, non-dollar trade among BRICS countries rose 20%, with China and Russia settling 90% of their trade in yuan or rubles. This erodes demand for U.S. assets, as countries need fewer dollars for trade. If this trend accelerates, the dollar's value could slide, triggering a sell-off of U.S. bonds and stocks. The Tax Foundation estimates that a 10% drop in the dollar's value could cost U.S. households $1,500 annually in purchasing power, driving up prices for gas, groceries, and imported goods. Emerging markets, while pushing de-dollarization, still hold $7 trillion in U.S. assets. A coordinated pullback could spark a liquidity crisis, dwarfing the 2008 meltdown. Geopolitical tensions are amplifying the risk. Trade wars with China, sanctions on Russia, and unrest in the Middle East are disrupting supply chains and energy markets. China's tariffs on U.S. goods have cut American exports by 15% since 2023, while Russia's pivot to Asia has redirected $100 billion in oil and gas trade away from the West. Middle Eastern sovereign wealth funds, holding $3 trillion in assets, are diversifying into gold and crypto, with gold purchases up 30% in 2024. This flight from U.S. assets reflects growing distrust in American financial stability. If tensions escalate, say, a major conflict disrupts oil supplies, energy prices could spike, further eroding investor confidence and triggering capital flight. The shadow banking sector adds another layer of danger. Hedge funds, private equity firms, and non-bank lenders manage $10 trillion in assets outside traditional regulation. These players are heavily leveraged, with complex derivatives tied to U.S. bonds and stocks. A single default, like Lehman Brothers in 2008, could trigger a domino effect. Bank of America estimates that a 10% drop in U.S. bond prices could wipe out $4 trillion in shadow banking assets, freezing credit markets. Unlike 2008, when global exposure was $20 trillion, today's interconnected markets mean a $41 trillion loss is plausible. This wouldn't just hit Wall Street. It would crush pension funds, where 60% of U.S. retirement savings are invested in stocks and bonds. A 15% market drop could erase $3 trillion in retirement wealth, affecting millions of families. The real-world fallout would be immediate. A market crash would slash corporate spending, leading to layoffs, potentially 2 million jobs, per Moody's Analytics. Higher borrowing costs would push mortgage rates to 8%, pricing out first-time homebuyers. A weaker dollar would drive up prices for essentials, with grocery costs rising 10 to 15%. Banks, facing margin calls and liquidity shortages, could limit credit access, hitting small businesses hardest. The CFIB reports that 40% of U.S. small businesses rely on short-term loans. A credit freeze could force 20% into bankruptcy within months. This isn't abstract. It's personal, touching paychecks, savings, and daily budgets. Could anything stop this? The Federal Reserve could slash rates or inject liquidity, as it did in 2008 and 2020. But with inflation at 4%, flooding markets with cash risks runaway prices. The U.S. Treasury could guarantee debt or buy distressed assets, but with $35 trillion in debt, further borrowing could spook investors. Global coordination, via IMF liquidity swaps or central bank interventions, could stabilize markets, but U.S. China-Russia tensions make cooperation unlikely. Preventive measures, like cutting deficits or rebuilding trade ties, are ideal but politically contentious. Once panic sets in, restoring confidence is nearly impossible. The 2008 crisis, triggered by a $500 billion Lehman collapse, froze global credit in days. A $41 trillion meltdown would overwhelm even the boldest rescue plans. Some analysts remain hopeful, citing strong corporate earnings and central banks' experience. They argue wealth doesn't vanish. It shifts to winners like gold or emerging markets. But skeptics see a debt-laden system hooked on cheap credit and foreign trust in U.S. assets. If that trust breaks, the fallout won't spare anyone. Retirees could lose 20% of their savings, small businesses could shutter, and prices could soar. The next few months are critical, with U.S.-China trade talks and BRICS summits looming. A single misstep, a default, a sell-off, or a geopolitical flare-up could ignite the crisis Bank of America fears. This $41 trillion warning isn't just numbers. It's a wake-up call for every investor, worker, and family.